It's-
All right, we are live, Rob. Good to see you. And Nadia, welcome back to the show. It's been a few years.
Yes, thank you. Hi, Rich and Rob. Yeah, I'm so happy. Thank you so much for having me today at your show. I'm very excited to be with both of you today.
Likewise, yeah, we'll give her a proper intro in a second, but we have back with us today National Association of REALTORS senior economist and director of real estate research, Nadia Evangelou. Nadia, great to have you back, and looking forward to the conversation today.
Me too.
Beautiful. So,
And Nadia,
Rob,
you're in Washington, D.C.
Yes, yes.
all your life?
No, I'm originally from Greece, as you can tell from my accent. But since I moved to the US, yes, here. I love this area.
And do you go back to Greece often?
Yes, every summer. Once, but every summer, yes, we go. Have you ever been there?
Not yet. Not yet.
Oh,
I'd like to go.
oh yes. You definitely need to go there.
it's high
Okay.
atop my place of places I'd like to go. I've never been to. I just heard it's gorgeous and the food is incredible. The people are
Exactly. Yes.
beautiful. It's,
Yeah.
just everything I love. Yeah. So love it.
And is Greece to plunge right into this in a sideways manner? I forget when the Portugal, Italy, Greece, Spain issue was an issue in terms of their debt markets, and it it
Oh,
it impacted worldwide debt markets and so on, stock markets. What was that resolved? Is that entirely behind us, or is it still a simmering issue with
yes.
I think Portugal, Italy, so on?
Yeah. So far, like Greece is doing much better. So we have economic growth. So we have positive growth there. So yeah, that was back like 2011, 12 back then. So yeah, it was like a little bit hard, but the good news that yeah, it's much better. I think for tourists, like, they could not like feel it, even though they were coming like during the summers, like or like other time in the years that we were not doing so well. But I think it's in the lifestyle of Greeks. They go out, they try to have fun, even though economically, I'm like then financially, they are not like in that position. But yeah, we're doing much better. So there's like more investments in Greece, and that's great to see.
Love it.
Good.
All
It
right.
goes to show you that the good times and the bad times, it's a cycle, right? Neither one ever lasts forever.
Yes, yes. But some years, yeah, they were very, very difficult. I can say that.
All right, let's go ahead and get into it. This is the big picture presented and sponsored by our great friends and partners at Depth. Nearly 2 decades of so ably serving the fintech, the mortgage space, providing exemplary brand management, strategic communication, public relations services for fintechs and other participants in the mortgage arena. And if you need your story told, they are the best in the biz at doing it. Check them out at depthpr.com. Legions of happy clients that we can connect you with that can speak to the experience of working with the pros at Depth. Carrie Milam and her two outstanding EVPs, Leslie and Lindsay. And yeah, or just get a hold of Rob
The
and I.
L's.
Yeah. The L's, Leslie and Lindsay. So it's good to see them, all the Depth team this week. They had the whole team out in Vegas doing a little team meeting and team building. So it was good to meet some of the Depth crew that I had yet to meet. So, and Rob, good to see you as always. You survived MBA annual and are back.
Yeah, it was 2 days ago you and I had lunch together.
Yeah.
Um, and it was good to see. It was good to see the folks from Depth, and you could easily, first of all, the Fountain Blue was immense, and just when you're kind of getting the hang of all the meeting spaces and so on, and where the seminars are, it's time to go home. But a lot of people got a lot of steps in and a lot of exercise, and there was a lot of valuable information. So, yeah, another annual under our belt.
Another annual under the belt. It was legitimate optimism, I would say, after, a lot of maybe fake optimism these last few years. I felt like that. A lot of AI everywhere. And The Pink concert, Rob. You were in attendance at the Pink concert. What do you think of Pink?
As were you.
Yeah.
Yeah, I've seen her live elsewhere. She put on a spectacular show with trapezes and dancers and all kinds of things. This was more subdued, and her talent is obvious.
Hmm.
But I think that many people were disappointed that the show was only 45 or 50 minutes,
Hmm.
and the build up to that was, a few hours, 2 or 3 hours, depending on when you got there. So aside from that, no, it was a good show. What did you think? You were down in the mosh pit, right?
Kind of like behind it. Yeah, it was good. Again, I went to go get a beer. I thought it was like the mid show beer run, and then it was just over. I was like, what the hell just happened? But she was very good. I mean, I am a big fan of her. She's mega talented, and to be able to see her in like a Vegas nightclub with like a couple thousand people was pretty cool. But yeah, so good
Yeah.
stuff. And this week, back on the show, uh, very pleased to have back today the National Association of Realtors Senior Economist and Director of Real Estate Research, Nadia Evangelou. Nadia, thank you again for rejoining us here on The Big Picture.
Yeah, thank you. No, it's great to be here. Yes.
Awesome. And excited to get
Always a
into it
pleasure.
as always, the chat, the Q&A, fire up the comments, the questions. If they're worthy, we'll incorporate them. And let's go ahead and get
What if
into
they're
it.
unworthy? Do you ignore
No,
them
we
if
just
they're
we just
unworthy?
ignore them. Yeah, just ignore them. But
Okay.
so Rob, some breaking news, of course, and this was a surprise. Bill Pulte just recently tweeted that he's working hand in hand with Barry Habib to lower LLPAs and home prices. So it's interesting to me on a number of different levels. This to me signals that they're prioritizing, obviously, using the GSEs as a utility and maybe delaying or deprioritizing taking them for another public offering here. If they're going to start lowering fees that lenders pay, you would think that would not dovetail with an IPO and investor expectations. But I cede to you for your thoughts on what to make of Pulte's latest tweet.
Well, yeah, there's all kinds of things going on there, and I just want to tell folks on the call that, and as I told you, Nadia, I do have to log off at that 15 or 20 minutes past the hour for grandfather duty. The the feeling is that, and I've written about this, the intricacies and the complexity of the Fannie Mae and Freddie Mac and the deals that they have signed with the government and vice versa, they don't exactly preclude some kind of release from conservatorship, but they're very difficult to achieve. And financially, the government stands to benefit handsomely no matter what happens. You or I or Nadia or anybody on this call could go out and buy stock in Fannie Mae or Freddie Mac. In fact, probably a lot of people have some. So it's not really a traditional initial public offering that's already happened. You could own stock in them now. It's almost a re-IPO or IPO light, and I think they've encountered difficulties with the contractual obligations and so on. So, all right, well, if that's not going to happen, the industry has seen Fannie Mae and Freddie Mac, and I won't say deliberately pull back or deliberately reduce their market share. But Rich, I mean, you talk to as many loan officers as I do. A lot of them, they lend through the private money segment of the business. They go to non-agency investors and aggregators and so on. And so Fannie Mae and Freddie Mac have seen they're still the predominant players in mortgage banking, but they've seen their market share diminish. So the question is, okay, well, if we don't want that to happen, what are we going to do about it? Well, let's look at some of the costs that make up Fannie Mae and Freddie Mac that non-agency lenders and aggregators don't have, like guarantee fees, like some of these loan level price adjustments. And so I remember many years ago when AmeriHome first started getting going, and Fannie Mae, Wells Fargo, who'd been in the correspondent business many years prior to that, had, let's call it, a half a point hit for non-owner occupied. I forget the exact LLPA that Wells Fargo charged. And when you talk to Wells Fargo, you ask them why are you charging a half a point more for non-owner occupied. And they would say, with our trillions of dollars of servicing portfolio, we've experienced that loss on that product so that we want to charge an LLPA for it. AmeriHome comes along and charges 0 for non-owner occupied loans. So of course, all the non-owner occupied loans go to AmeriHome. And then what happens is AmeriHome, when they start building their servicing portfolio, finds out that, gee, lo and behold, there's a reason why Wells and all these other companies were already charging for non-owner occupied loans. So then they implemented a non-owner LLPA. So one believes, I believe, that Fannie Mae and Freddie Mac, through their decades and decades of experience and looking at loans and slicing and dicing, have seen certain losses on certain parts of their portfolios, and they reflect those losses in loan level price adjustments. Now, if somebody come in and wave a wand and just do away with them, fine. Maybe lower the guarantee fees because the credit quality of what's being underwritten now and funded is so much better than it was, say, 10 or 15 years ago. That's another possibility. So, here's to them for taking a look at it. There are plenty of ways to make the agencies more competitive with the non-agency investors that are arguably eating their lunch right now. So we'll see what happens. Good for them. What did you hear? What are your thoughts, Rich, with regard to that?
Yeah, just some of the same stuff that a republic offering, not quite as quick and easy maybe as they initially thought. And, the more they think about it, like, they want at the end of the day stoke housing and get the housing market going. And we've talked about this on the show a number of times. They could do it tomorrow by lowering G fees and LPAs, literally. So I'm encouraged. I mean, I really am. I mean, to me, it's a good sign, and we'll see what happens. You got to, with this administration, you got to, sometimes the initial headlines are, more marketing. But you would think that this is legit. They're looking at this and that this could be some pretty significant relief to the mortgage market, depending on what they do. That could be a nice catalyst as we go into winter. So we'll see. I'm encouraged by it, and we'll see what happens. So
Yeah, exactly.
cool. And Nadia, some other news that kind of released over the course of the last day or so. I think this was your report, maybe not you personally, but NAR. Inventories up 14% year over year. And home values, I think you guys, what, 2.1%, I think, year over year?
Yes.
And the monthly is kind of flat, but your thoughts on those recent releases and maybe any trends you see attached to those reports?
Sure. So, and I'm glad that we met like today because we just released like in the morning. We had like the latest existing home sales like figures for the month of September, and the numbers are looking better. So as we expected, like people are responding to the lower rates during that we had like at the late like August and September, and sales closings have increased like 1.5% when we take a look from month to month, and then about like 4.1% from a year ago. So we see that people are definitely responding like to these lower rates and a modest, I will say, increase in affordability. But I think we get, because I received this question, so we get something really interesting after we go beyond just like reading the data and comparing with how people reacted a year ago. We need to have this in mind. A year ago, when the Fed cut again the rates, like last September, so in September 2024. So this year, it seems that people are responding like much better than a year ago when we are almost like at the same like situation. So the rebound in sales activity is stronger this time, even though like mortgage rates in September were still higher than they were like a year ago. So if you remember, like back in September of 2024, they went down to almost like 6%. Like
the
one
mini
day,
refi, 2-day refi boom. I remember that. Yeah.
yes,
A couple days or something.
Yeah, but then I'm like, if you remember, I'm like, they went up by like October, they were up to 6.7%. So yes, So that was the thing. And last September, home sales were down about like 3% year over year, and slipping up month to month about like 1%. So why is that? Like this time we have like more people, like more buyers than we had, like responding to these lower rates. I think here are a few things that we have to have in mind. Like, first of all, the rates have stabilized. This is what we see. They're like rates are about, and also the expectations like have shifted. So the rates are about like below the 6.5. They're about like for a month now, near 6.3%. Like according to Freddie Mac, it's like 6.27. So that's great that they're like they have stabilized. So people like reacting to that, like that, and they see that rates are not moving as they were moving like last year. Then and psychologically it feels that like a turning point. Then what also we have to have in mind that wage growth is stronger than inflation and home prices. So real income growth has outpaced inflation. So this year, so that means buyers have a little like more purchasing power, and some households that they were priced out last year can now qualify. So, and to give you like an idea, like when mortgage rates drop from 7% to 6%, we have about like 5.5 million households who are able to afford again to purchase the medium priced home. So of course, not all of them buy homes, but about like 10% of them, like we see them that they do. So that's the reason we expect like this time as well, like to be better, like from last year. And of course, labor market, this cool down like in the labor market is one of the reasons. The main reasons that we expect also like the Fed to continue with the rate cuts, and these expectations are already like investors. I think that they're already like recognizing that there are going to be these rate cuts like in the following months.
Yeah.
However, as you mentioned, like home prices continue to increase, like of course, and we can discuss a little like more like about the inventory, because you mentioned like about the inventories more, but it shows since home prices continue to rise, we have home prices to rise, more inventory, home sales, we have this increase. However, we don't have the reaction from the buyers that we expected. So we have about 15% like more inventory than last year. We have the best inventory in the last 5 years, almost like since 2020, but home sales remain stuck. So they're like at the lowest levels in the last 30 years. We see improvement this month, like in September, but still we're relatively like at the low like levels. And the main reason is like about the availability of affordable listings out there. So
yeah, Rob, before you go, that's great stuff, Nadia. And and I mean, what Nadia hit on a couple of times.
Are we done talking about inventory as a problem?
Yeah,
for a while.
So, but that's what makes, if they were to reduce LLPAs, and there's a bunch of stuff in the chat, there was not just second homes. It was a tweet that basically said he's working with Barry Habib to lower LLPAs. I was something along those lines. There was no second home note specifically for Bill. And Joe, yes, good seeing you at the Blue Bar in Vegas. And Dana also confirming she was on a Barry Habib call where he confirmed that he's working with Pulte, and his rate forecast is 5.5 to 5.75 for next year. In fairness, Barry Habib has been predicting rates would be going down for the entire last 3.5 years, but this could be a legitimate one. We see, Rob, like when we've had these, Nadia alluded to, these little drops in rate, it's put a lot of people off the fence. We've seen the change in the numbers, and the more I think about this, like, if they could stoke housing like overnight, and what it would create, which is going to be very interesting, if they do this, if they go out and lower LLPAs or G fees or both, it's going to put the Democrats into position where they're going to be dogging the Republicans for using, almost like the flip flop of like all the Republicans wanted Fannie and Freddie out of conservatorship. They didn't want the risk, didn't think the government should be in mortgage forever. And now you could have a flip-flop situation where Trump uses them to stoke housing in the economy through lowering fees, and the Democrats will come in and play the safety and soundness card, right? That's how this would play out if I'm thinking about this.
Chaos. Who knows? Who knows? I think I mean, if you want to, I'm not going to get into politics because I do have to jump off. But certainly if you look at what Republicans were working with, say 20 or 30 or 50 years ago, or Democrats during that same time period, many of the issues have almost flip-flopped. So
Mhm.
this could be another one. But I gotta jump off.
All right.
I gotta
Well,
jump
good
off.
seeing
So
you.
Nadia,
See you
good talking
next.
to you. Thank
Yep.
you,
Yeah,
Rich, and
bye-bye.
we'll see everybody next week.
Sounds good, Rob. Thank you. And so Nadia, I want to get back into more on the inventory side of things and some of the other things you hit on. But first, let's go. The Fed, of course, meeting
Mhm.
next week. And I checked right before the show, looking at the Fed funds futures market, 99% chance of a
Mhm.
25 basis point Fed cut next week. And then also now, the December 10th meeting, a 92% chance of another quarter. So pretty much the market locked in a quarter point next week, a quarter point in December. Any dissenting opinion to that from you?
So I think investors already expect that. So, and the reason that mortgage rates remain like, or the 10-year treasury like fell to the lowest, like, so it was very low, like the level that went. I think investors already priced in, and the market priced in all these potential um, uh, anticipated like cuts from the Federal Reserve. So this helps as well with the rates to remain close to the 6%. I mean, the low mid range of the 6%. And I don't expect to see like mortgage rates to react like to see any significant like decrease, but like small steps like with the mortgage rates. And again, if it's like I think they're going to be about like 6% for 2026, and maybe we may see like 5 in front, so 5.9%. So next year, if this rate cuts will continue like from the Federal Reserve, but also it's like about labor market. I think this is where the Federal Reserve is very concentrated, focused on about the slowdown in the labor market. Unfortunately, we don't have the data now from due to the shutdown. All the releases are, yes, they are suspended. So that's something that creates a little like uncertainty for the Federal Reserve as well to do policy.
Yeah, what Nadia is alluding to there, more breaking news, and I haven't had a
Mhm.
chance to really read into this, but it was not long before we went live on the show. ADP, the large national payroll provider that
Yeah,
provides, or I guess provided, the federal
yeah.
government with a lot of payroll data. ADP came out today and said they're no longer going to be doing that. So that's going to be interesting. And, obviously the dual mandate of the Fed, Nadia, it is, obviously, um, the rate part of it, but also full in managing inflation, but also full, what they call full employment.
Mhm.
So, we've talked on this show ad nauseum about the accuracy of some of that jobs data not being great over the years, but still, it's going to be interesting to see how that affects things with ADP no longer making their data available. But and on the rate
Yeah,
side,
and
oh, go
yeah, when
ahead.
we know like ADP's employment reports have long been used as a high frequency, I would say, gauge of labor market like trends ahead of the official government data. So usually they come before the data that we have from the BLS. So without that direct like data sharing pipeline, like the Federal Reserve may lose an early signal, I would say, on hiring and wage pressures, or at least temporary, making it like harder to calibrate and to decide like what policies to follow in real
Yeah.
time. So yeah, and especially with the shutdown that we're currently still there, so that's a little bit even more is adding like more to the uncertainty that for the Federal Reserve to take like action.
Yeah, yeah. And you said your forecast currently, Nadia, for next year is kind of like 30-year fixed rates dipping into the high fives, kind of like a slow bleed down over the course of, the next 15 months.
So yeah, they're like currently 6.27. So I assume they're gonna be like 6.2, and next year 6% to average like a 6%, and we may see like 5.9. But again, 6%, like I think it's great to say it. So and that will attract like more buyers out there. The thing is that, of course, if there is enough inventory, because again, with more buyers out there, this can create like some competition, especially at the price points that people can afford to buy. So the listings that are at that price ranges, unfortunately, then we may see, and that's the main reason that even though with more inventory, we still see prices to go up, because they don't go like so up that they used to be like in the recent years, but we still have price appreciation. But we have to have like more inventory and the price point is that people can afford to buy.
Yeah, affordable. It's something I've been talking about in this show for a while. Some sort of
Mhm.
seller incentive, and maybe more aggressive or exclusively for, people selling homes kind of at or below area median values. We've talked maybe about incentives for owners, individual owners of investment
Mhm.
properties, could be another good strategy. But
Capital
yeah,
gains exceptions. Yeah, capital gains exceptions is something that we are advocating for that, because this
oh,
will
good.
help many existing owners. Because I think many times we often talk about the need to build more homes, and rightly so. Like, but before we can understand how much we need to build, we have to start with what's already like on the market. Because as you know, like 9 in 10 homes, almost like 85% of the homes that Americans like buy are not new. So these are existing homes. So the biggest part, and that part of the market, I think, tell us a lot about where housing stands like today, and what we need and what we should like expect like in the future. So with more giving like more incentive to existing homeowners to list their homes, this can help with the inventory, and to have like more options for buyers over there. Because and especially like at the right price point, then more homes will mean like more sales, but we don't see that yet. And
Yeah.
yes, so and usually in normal years, because we are still experiencing one of the most unusual like times in the housing market, we went from record low mortgage rates, then we went to the highest rate hikes in the history, like in decades. And then we also had like price appreciation, double-digit price appreciation. So now we have an adjustment period. We have like inventories are rising, finally are rising, but and this could also mean, and home prices are relatively flat, like 2% compared to like 7% or 10% that we had in recent years. So that shows that prices have been stabilizing. So so this should be also be an adjustment like years. But and usually when we are in a normal year, we have like, when you have like more homes available for sale, this also means like more sales. But we don't see that yet. We have some improvements, but still we don't have the activity hasn't picked up the way that we expected, because all this time we're saying we need more homes to be available so we can boost activity. But more homes, we have more homes, but we don't see that yet. 2025 has been one of the slightest like years for the market. And the reason for that is because we need to go beyond just like counting the inventory. We need to go and ask who can afford to buy these listings. And what we see, because we track that, what we see is that people, buyers who earn about $75,000 per year, who are like the middle, roughly the middle income buyers, can afford to buy 21% of the listings out there. And what we want to have in a balanced market, we want to have for them like to be able to afford half of the listings. So we are missing many listings that specifically like they can afford to buy, like currently about 380,000 listings. And in a balanced market, they should afford to buy about 870,000 listings. So we are missing about 500,000 listings with a price up to $260,000. So for them to be able to be in a more balanced market. So we would continue, because many times we hear that there are more sellers than buyers, what's going on out there. But yes, there are like more sellers. We see that luxury market is outperforming. So based on our figures like today, luxury market is 20% higher, like the home sales, than a year ago. So when you take a look at homes sales, $250,000 and less, then you see about like 6%. And again, this is this month, like September's data, that we have like more home sales. But before the previous, like recent like months, we had this gap between luxury and homes below the $250,000. There was a big gap with luxury market outperforming double-digit like gains in sales activity, while we had like negative growth. So we had like less and less, fewer and fewer like home sales in the price ranges to $150,000 and less. So this can also show that we need to add. It's important. It's great that we see these more homes available for sale, but the challenge, I think, is to add the homes at the right price point, like the points that they can afford to buy.
This is the big picture, presented and sponsored by the fine folks at Depth, the best in the biz at telling the story of companies. depthpr.com if you want to learn more about the team at Depth and what they do, or just get a hold of me or Rob and we'll be sure to connect you. So, Nadia, great to hear NAR advocating on behalf of waiving cap gains, taxes on home sales. To me, this is the best way to get more affordable priced homes in the market, to incent owners of investment properties to sell them to owner occupants. Anything else that NAR is advocating for on the supply side, or just in general that that your organization feels could have the biggest impact on getting housing going a little bit more?
Sure, about construction as well. So relaxing like the zoning regulations, especially in some areas that unfortunately we're not able to build because of the zoning regulations. It takes like longer, so streamlining some the process over there. So and it takes like long, for example, take like permits. So of course we advocating on the new construction as well. But sometimes I think because many people are out there like advocating for that, I think it's very important, and that makes a big difference. I think advocating for something like to help existing like homeowners, because we understand that all these like are locked in. Some of them, they want to move, they want to sell their home, they want to downsize, but they don't do it, for example, because they don't want to pay the capital gains tax that they have to pay. So like waiving, increasing this the limit of the exemption, so that can help like with more homeowners that they feel locked in their homes. But yes, so this is something we need to have also, I think, in mind. And this can also help with many older adults like doing this move, relocating. Many of them, we know that they want to relocate and they don't want to live in these like big houses since they don't have the kids. Usually they go to Florida. We continue to see this trend, but there are many of them that are thinking about like their low rate that they have and also the capital gains that they have to pay the taxes.
Very pleased this week to be joined once again by National Association of REALTORS senior economist and director of real estate research, Nadia Evangelou. And Nadia, if you look at like how many homes we need to build in America just to get to the number we should have, somewhere like between like 1.5 and 7 million homes, like depending on which organization you look at. Where is NAR on that in terms of like the housing shortage in America and the construction need?
Yeah, so now we're around like the 4.4 million units. So we were like, I think 2 years ago, we're about like 5.5. So we have more construction. That's great to have like this construction. So I think it's like more than we expected to see. And another trend in new construction that it's very interesting is that they're starting like building smaller homes. So they have smaller homes on smaller lots, and that can make like prices to be closer to what people can afford to buy. So, and what we have seen, for example, is that the median price of the new homes, new home sales is like lower based on the August data that we have, the latest like that we have from the government, than the median price of the existing home. So, and usually what we see is that existing homes like are usually like 20% like lower than the new homes, but we didn't see that like in the August figures. We had the same like last year in the summer, But the encouraging is that they're building like smaller homes. So the size of the homes was about like, it picked up like in 2015. And then we can see that it's trending down like less than 2,200, like I think, square feet. So that's encouraging and can help with more people like having like more options there.
Absolutely. Question in the chat from Dana. Nadia, do you have numbers of what percentage of senior citizens would or could sell if a no capital gains tax policy was implemented?
Yeah, that's an analysis that have in progress. So we are going to release something, and we're going to have it because the way that we do it, we have a dashboard in an AR, so members are able to see many, like whatever they need to know for their specific like area in just one place. So we are working on an analysis about the capital gains, like how many of older, especially like homeowners, will be able to. They have like higher than the limit. They should like pay capital gains taxes, but I don't have the figure now, unfortunately. But we are working on that.
Oh, cool, awesome.
Yeah.
If you remember when you put that research out, if you could shoot it over to me, if you remember to send it to me
Sure.
on email. Yeah.
Yes, and we are going to have it at local level as well. So by metro area. So this is how we're working, and specifically find the areas that there will be like most benefited from this change. So that's the reason we go at local level, because people don't buy homes in the national market. They buy homes or like in Dallas or like in San Diego, for example, or like in Houston. So they're like all real estate is so local. So that's the reason we go like at so local level, just to show what the effect like of policy changes like can affect the housing market.
Yep, makes sense.
But most of the majority of older homeowners, I think they're like they own the homes like before 1990s. So, and we know that they have appreciated like since then a lot, like their homes. So there are many of them that they're gonna feel a relief, I think, when there are some changes.
That would be great to see. Nadia, cash buyers, investor activity in general, what's your data showing you? Some updates, trends in those arenas?
But yeah, one of the biggest shifts like in the cycle has been who is buying, I would say. So, and data can help us identify those buyers. So today, what we see is that about 1 in 3 home sales is an all cash purchase. So one of the biggest like shares in over a decade. It's not the biggest. So based on the data like that we had to date, 30%. So in recent months, we had like 34, 35. So it's not the highest, but it's one of the high-end like percentages. Like to give you more context, like before the pandemic, it was the share was about like 21%. So we have this cash purchases, and one in some markets, of course, we see like more buyers paying all cash, and these markets are usually like in Texas, in Florida, like Naples or Sarasota in Florida, that the share climbs above like 50%. So it's about like almost like 60%. So what that tells us is that the market has shifted, like higher income and investor buyers who are less sensitive to mortgage rates remain active. So they're either buying with cash or smaller like loans, because they can do that. So, but meanwhile, middle income and first time like buyers who rely on financing are sitting like on the sidelines, unfortunately. So, and as I mentioned, the luxury like segment in particular has been a bright spot, as I mentioned. So, so it's not that demand has disappeared, it's shifted. So, and the profile of who is buying has changed. Regarding the institutional like buyers, because we hear like about the institutional buyers there as well. When we take a look in big companies like corporations, these represent about roughly 3 to 4% of the home purchases. When you add the LLCs, which unfortunately we're not able to see by how many properties they own. So some of the LLCs that are big, like they have bought like purchased like many properties, but some of them just like purchased one or two. So there are some big LLCs, some small LLCs. So when we add LLCs with corporations, big corporations, then the share is about like 15%, and it's relative. It's going with the market. So when we had higher mortgage rates, that share was relatively like lower. So when the rates are a little better, we see like more activity over there. But what's very interesting to see is that many of them also pay all cash, and that's one of the concerns like for many markets, that they have many investors over there, but about like first-time buyers how to compete with cash buyers over there. So unfortunately, that's something that it's one of the concerns for local residents, when sometimes like cash buyers like or like buyers, individual buyers come like from New York, from Connecticut, and they move to Florida, for example, and they're able to sell their home in their area, take this accumulated like substantial wealth that they were able to accumulate, and then pay all cash for the next purchase. So we see that very often now, especially in these areas, with benefit from these older homeowners like moving there, that they have like substantial wealth.
Yep, makes sense. Nadia, regional divergence trends, maybe any markets you're seeing that showing resilience, or on the flip side, maybe that are softening quicker than others?
Sure. So sales activity since the beginning, when we take a look at the sales activity since the beginning of the year, is performing like better in the Northeast and Midwest and South, but that's not the case for the West. And of course, this comes down like to affordability to be like the main reason for that. Regarding to improvements in affordability and availability, so when we take a look at how like the markets have improved affordable housing over there, like to match better with the incomes, the local incomes. So then we identified three categories of markets. So we have the markets that are getting closer to a balance. And these are the traditionally like affordable areas like Akron, Ohio, St. Louis, Missouri, Pittsburgh, like in Pennsylvania. So these metros are adding the right kind of supply, homes that are priced in line with local incomes. Then we have some of the markets that are stuck in the middle, like stuck in place. So metros such as like Seattle, in Washington, like Washington, D.C., that they have added some affordable listings, but not enough to change the picture or go closer to them to balance. So in both of these places, we see, for example, to give you some more context, like households need to earn more than $150,000 per year in order to be able to afford half of the listings. And then, of course, we have the areas that are falling further behind, such as like the usual suspects like Los Angeles, San Diego, New York, remain among the least affordable. So in Los Angeles, for example, even households earning $200,000 struggle to find homes that fit standard like mortgage like ratios. So we see improvements in some of the areas, usually that they're able to build like more or the traditional, like they can match with the local incomes. But unfortunately, we still have some of the areas that are falling behind as the usual suspects with low affordability.
Love it. And Nadia, I want to thank you so much for coming back on the show today, sharing your insights and expertise. You see as your role as a senior economist for NAR, and yeah, just really enjoyed the conversation and appreciate your time this afternoon.
Thank you, Reed. Yeah, thank you. It was a pleasure.
Yeah, I want to thank also all of you for taking part of your week out with us. We do the show live every Thursday from 3 to 3:45 p.m. Eastern on Zoom. You can go to chrismancommentary.com to get signed up. We'll keep an eye on all the latest on LLPAs. This could be major housing stoking news if they do indeed decide to. Nadia hit on about 5 different times today, like just the impact they've seen of these small bump downs in rates, the activity that's followed, and could be a huge catalyst for housing if we see that. And we'll obviously keep tabs on that. And yeah, well, thank you everybody for joining us, and I hope everybody has a great rest of the week and weekend. And we'll see you next Thursday here on The Big Picture. And thanks again, Nadia.
Thank you. Bye-bye.
Take care, everyone.